And just recently, my financial advisor called me to introduce a fixed income investment. The brokerage firm, just introduced, and he was telling me about the possibility of earning about 20%, a month. I think it's a very good investment. So in this video, I want to talk about the power of fixed income investing, that is building a stable investment portfolio. When we talk about fixed income investing, it has to do with investing in a financial instrument that guarantees regular income, that provides regular income, regular returns in form of dividends or interest, as the case may be. These investments are typically less volatile than equities, and they provide a steady stream of income. And so including them in your portfolio is quite advantageous, and it's very good for investors who are conservative, who cannot really withstand the volatility that is inherent in stock investing. And so here is a comprehensive overview of what fixed income investing is all about. So here are the key concepts of fixed income investing. We have to do with the definition and the purpose of this particular strategy. So when it comes to fixed income investing, it involves investing in securities that provides, periodic interest payments, and and return the principal amount at maturity. You have the principal amounts, intact, as well as the interest at the end of the period of the investments. So common fixed income securities include, you have bonds, you have certificate of deposits, and you equally have preferred stocks. These are typical examples of fixed income instruments. So what essentially is the objective of this strategy? It's there to generate a reliable stream, of income, and as well as, more importantly, preserve your capital. Your capital is preserved, and it equally provides diversification to reduce the overall risk of your portfolio. Number two is, types of fixed income strategy securities, types of fixed income securities. Number one here is bond. When we talk about bonds, you have, government bonds, municipal bonds, as well as some corporate bonds. So when it relates to, when we talk about government bonds, these are bonds that are issued by the national governments. Every country, most countries issues bonds, so they are generally, considered to be low risk. Government bonds are considered to be, low risk instruments. You have municipal bonds. These are done by the local governments, and of course they offer that tax advantage. Government bonds are offered by the federal government, by the central government, and municipal bonds are bonds offered by the municipality, by the local governments. You equally have corporate bonds. Corporate bonds are issued by companies, by corporations. They are generally offered at a higher yield, but they come with a greater level of risk compared to municipal bonds and government bonds. The other one is a certificate of deposits. They are offered by banks, and credit unions. The certificate of deposit provides a fixed interest rate for a specific, term. I had MTN. MTN is offering certificate of deposits. If you buy, you stand to, it attracts a fixed interest, and you, of course, by the time you hold it to maturity, you have your interest, and your capital will be returned back to you. You have preferred stocks. Preferred stocks essentially, have these fixed dividends that is paid regularly. compared to a typical common stock that is not, whose whose dividend may not be guaranteed. In the case of preferred stocks, the interest, the dividend is guaranteed. And in the case where they cannot pay dividend at a specific time, dividend could be, forwarded, could be, carried forward until when they're able to have the cash to pay out these dividends. You equally have, fixed annuities. These are insurance policies or products that provides, a guaranteed, periodic payments for a set time or for life. So annuities equally, provides this kind of regular income. Number 3 is want to examine the key characteristics of fixed income securities. Number 1 is interest payments. They provide interest payments. So fixed income securities, pay regular dividend. In the case of bond, it is called coupon, and in the case of stocks, it is called dividends. And they are done at a predetermined interval. You equally have, a principal repayment at maturity. You get to collect your capital. I think it's a very nice kind of investing, with lesser risk attached to it compared to, equities. There's that, credit risk. The risk that the issuer may default on its payment is equally there. So government bonds generally have a lower risk, but corporate bonds may default. Although even some governments can even default on their bonds. In that case, the nation is going bankrupt, but generally they are considered safer than most other forms of investments. There's also a time frame, a duration attached here. So it measures the sensitivity of bonds price to changes in interest rates. So longer duration bonds are more sensitive to interest rate change. Although longer duration bond tends to have a bigger, level of coupon, a bigger amount of coupon, but then they are subject to various changes in interest rates. We should take that into consideration when it comes to investing in income, when it comes to fixed income investing. So we want to look at the benefits. That's number 4, the benefits, the advantages of investing in fixed income instruments. So there's that stable income. You have stable income coming in form of coupon or in form of dividend, and it's very good for retirees and for people who prioritize regular income. We equally have capital preservation. This is fantastic. This is wonderful. Your capital is preserved. Is that guaranteed that nothing happens to your capital. So it is lower risk compared to equity, with a focus on making sure that your capital is preserved, as well as the interest on it at the end of the day. Not only that, you have diversification. It provides diversification away from stocks and away from other asset classes that could be risky. That guaranteed diversification is very, very important. I want to look at the drawbacks, the disadvantage, the pitfalls involved in fixed income investing. Number 1 is lower returns. It's lower. The return is generally low. They may tell you, usually, in a typical bond offering, you may not get up to, generally, you may not get up to 20%, 20-something percent. Generally, they come in lower single digits. So it has a lower return, particularly in the case of bonds, compared to equity that can even double in 6 months and quadruple in a year or 2. That's a discouraging kind of disadvantage of fixed income investing. There's that inflation risk. Your money may get devalued, your purchasing power may be lowered by inflation. Let's say you're having, the inflation rate is probably maybe let's say 10% inflation rates, and you are fixed income, the income coming in is equally like 10% of your capital. In that case, your money is your return is eaten up by inflation. There's that interest rate risk, because interest rate keeps on changing. When interest rate rises, the value of existing fixed income security will decrease. It's a kind of inverse relationship. So whenever there's an increase in interest rates, the value of of your bond coupon, your dividends, your interest tends to depreciates. So we want to look at the strategies for fixed income investing. What are the strategies involved in fixed income investing? Number one is what is called ledgering, ledgering. So investing in bonds or certificate of deposits, with different maturities to manage, interest rates and ensure regular access to capital. So you tend to you invest in bonds and invest in CDs, and they all come with different maturity, periods. Some maybe a year, some 2 years, some 3 years, some 10 years, some 15 years. By so doing, you are better able to manage interest rates and rate risk. So it equally involves diversification. So you hold a variety of fixed income securities. It might be government bonds, municipal bonds, it might be corporate bonds, it might be CDs. By so doing, you tend to diversify adequately across different fixed income sources. You equally have duration management. So in this case, you adjust the duration of fixed income investments to align with interest rate expectation and your investment horizon. When you invest in these kind of securities, you equally take into consideration the maturity periods, so as to be able to mitigate the impact of interest rate fluctuation on your overall portfolio. There's that it gives you quality selection. So in this case, you have the leeway, the advantage of investing in high quality bonds or securities with strong credit rating in order to be able to minimize your risk exposure. You see, so you select the quality of bonds you want to invest in, considering your risk appetite. And so who is it actually meant for? It's for those who are conservative in their investment approach. It is meant for retirees, and it's meant for those who want to diversify their portfolio, across different investment mix or across different asset classes.